Hi, this is Professor Ruja with your introduction to Module 6 for Accounting 104. So you'll notice Module 6 is actually quite brief. It covers chapters 10 and chapters 11, but only in part, because the emphasis here is on concepts and definitions and sort of understanding, in this case, the liabilities and the stockholders' equity section of the balance sheet for corporations. So chapter 10 starts with basically a focus on current liabilities, things that we haven't covered already. There's some things that you already know about, like accounts payable and notes payable. But here we're looking at other liabilities that are extremely important because corporations are the best tax collectors the government has. Corporations are required to collect sales taxes, for example, for state and local governments. And so every time you go to purchase something and they collect a sales tax, that's a liability for the corporation or the business that's collecting that. So it shows up here as sales taxes payable, a liability. Also, when you look at your paycheck, there are a number of taxes that are withheld from your paycheck, be that from Social Security or Medicare, your federal income tax withholding, or your state income tax withholding. That money is set up in the corporation as a payable, as a liability, because the corporation needs to send that money to, in the federal government's case, the IRS, which is the collection agency for the federal government, or for the state of New York, for example, the Department of Revenue in Albany. So this is where that money goes from the corporation. It's the corporation that is collecting it, whether it's from a sale of a taxable item or from your paycheck. They have to record that as liabilities. So this is one of the more important things to sort of understand. And in addition to actually taking money out of your check for things like Social Security and Medicare, you got to understand too that corporations and businesses have to match what you put in to Social Security and to Medicare. Those are payroll taxes that are not shown on your check, but are expenses for the business. They also need to contribute to the unemployment compensation system, which is technically a federal program, but it's really run by the states. And so that money is also taxed for every employee. There's a tax on the first few thousand or several $1,000s of earnings that is paid into the state and the federal government to run the unemployment compensation funds, which are very important now with high unemployment. This is where the government gets the money to pay those benefits. So it's important to sort of understand how that turns into liabilities for corporations. That's really the important part of the beginning of chapter 10. In the middle of chapter 10, we're really kind of looking at long-term debt in the form of bonds. Bonds are basically long-term loans from investors, okay? There's a lot of people are focused a lot on the stock market and understand a lot about the stock market, but the bond market is significantly larger and is very, very important because this is where investors go to lend money, be it to corporations, to governments. The bond market is exceptionally important today. It's always been, but you'll have to read up a little bit on the types of bonds. We're just looking at basic features and understanding what they are. You don't have to understand the pricing or other stuff. We're skipping all over that for the sake of this. You'll get that in a finance course in the future. But here, the most important thing is sort of understand what these things are, and then you can get the details later. There's only a couple of homework assignments in chapter 10, but they cover the whole chapter. There's a couple of financial ratios in chapter 10, such as the debt to asset ratio and the current ratio that it ends. And then moving into chapter 11, again, I would start with that story on Facebook. It's a very good story. And then just understand that corporations are unique forms of businesses. They certainly have advantages and disadvantages. And your chapter starts with that. But also understand that the owners of a corporation are stockholders or shareholders. A share of ownership is what we call stock. It's an interchangeable term. So stockholder, shareholder means the same thing. And so sort of understand that the only way corporations are born is they need to apply to the government for recognition. And you can incorporate in any of the 50 states. Business law is a jurisdiction of the state government, not the federal government. And so if you want to form a corporation, you're going to be applying to become a corporation in the state you want to apply to. Now, even though you are located in New York, you can apply in any of the 50 states that you wish. You can incorporate anywhere that you want. Delaware is a favorite place on the East Coast because Delaware's corporate rules are a bit more favorable to the corporate structure than some of the other states. But you can literally incorporate in any state. Once the state approves your application and recognizes you, it recognizes the corporation as a number of authorized shares of ownership. From the authorized shares of ownership, this is where corporations decide to sell shares to raise money. And so understanding the idea of what authorized stock is, and then the focus from that to selling shares, which are called issued shares to raise money. When a corporation buys back shares, that's treasury stock. And then outstanding shares, the shares that are still owned by the public. Those are important concepts to understand. Also, the Chapter 11 talks a bit about the difference between paid-in capital and retained earnings, because there's two parts to stockholders' equity, right? There's common stock, which is paid-in capital. This is the owners paying money into the company in exchange for those shares of ownership. And then there's retained earnings, right? The profits of the company that are retained in the company. Those are also owned by the owners. That's why they're a stockholders' equity account. The owners own the profit. So these are important definitions and concepts to understand. There used to be a big thing on par value. It's sort of going away as things change over time. So you don't have to worry so much about it, but it's an artificial value that's assigned to common stock for accounting purposes, really. Okay. And then it looks at the idea of dividends. And so we're going to focus only on cash dividends. That's the most common form of dividend, although there are other types of dividends like stock dividends or property dividends. You can read up on those, but they're not going to be on the test. And so the cash dividend is really the most common thing to understand, and what you really need to get out of this course is understanding the most basic information that's going to help push you into the upper courses as you go from here. And then there's a little bit of analysis for this, and it closes out. So it's a very simple ending to the course. I hope you enjoy learning about stocks and bonds in these two chapters.